Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll be discussing 6 tax planning mistakes that could ruin your retirement and how to avoid them. When it comes to tax planning, that's often something we don't think about very much. But taxes, Uncle Sam, he's always going to be there. And if we're not making plans to avoid giving him all of our money, then he's going to do his best to make plans to take all of our money. As a result, tax planning is something that most people overlook when it comes to retirement. Whether you're talking about Social Security, which is taxed, whether you're talking about your 401k, your 403b, those are also taxed. Even if you have rental property, capital gains from investments, those are all taxable assets. So when it comes to creating a retirement plan that works for you, you have to consider taxes in the overall amount, because you may have figured out using a retirement calculator how much money that you need for retirement. But if that retirement calculator does not even take into consideration taxes, then you may be thinking you're going to have more money than you actually will. In fact, that is the number one mistake most people make when it comes to tax planning, and that is they don't even think about taxes. Most of the income that you're going to receive in retirement is going to be taxed. And if it is taxed, how much will that impact your income? Most things, if you think about capital gains taxes, those are at 15%. If you think about your regular income tax, depending on how much money you make, that could be up to, I think it's like 37% currently. But, a lot of people pay somewhere in that 20 to 25% range. If you think about the different deductions and things that maybe you've been able to take advantage of, and you don't have those deductions anymore when you're in your retirement age, you really have to think about retirement and how taxes impacts that overall number. And you have to think about how much money do I need when I take taxes into consideration. The second mistake that most people make when it comes to tax planning is automatically assuming that their taxes are going to be lower in retirement. And what I'm talking about is you have pre-tax assets. That's like your 401k, your 403b, things that you put the money in before it is taxed today, so that when you take the money out in retirement, it would be at a lower amount. And while this was more of a slam dunk when we're talking about like today, where taxes are at historically lows, and then you would have deferred taxes in maybe the 1980s, where taxes would have been at historical highs, where I think upwards of like 91% of your assets could have been taxed. Now, granted, it was on a scale, so it's not like all of your 91% would have been taxed, but you would have had taxable assets where it would have been my income up to 91% would have had some amount of it being taxed. And so if you would have made $100,000 in the 1980s, you probably would have been taxed somewhere around like 55% of your income. And then today, if you retired because you deferred those taxes, you put them in your 401k and then you didn't do anything with it, and then in retirement today, you would have taken the taxes on it. Well, $100,000 in today's tax bracket would have been taxed, and I think it's about 22%, 22 to 24%. And the reason is there are fewer tax brackets today. There's only 7 tax brackets today. So as a result of having like dozens of tax brackets back then, you could have made the smallest tweaks in your income and it would have lowered you or increased you into a different tax bracket. Because we only have 7 tax brackets today, it takes a lot more work to be able to actually move into a different tax bracket. In fact, and if you want the information that I'm reading off of, you can go to obsidianwisdom.com/tax planning, and you can get that tax planning guide where you can take a look at that guidebook to help you make sure that you're not making any of these 6 tax planning mistakes. But basically, we have 6 brackets. So if you're being taxed at 10%, then you would have been a single filer. So that means you just file alone. You would have had under $11,000. And then if you're filing jointly, it would have been double that. So it would have been $22,000. You would have made under that. And then if you would have been taxed at 12%, you would have made somewhere between $11,000 over that to about $44,000. And that would have put you in the 12% bracket. The 22% bracket would have been $45,000 to about $94,000. And you can see that basically you would have had to lower your taxes, your taxable income, by over $50,000 as a single filer to be able to have lowered your overall taxes from that percentage amount. And so you can see how difficult it is for you to change the brackets. And then if you would have been in the 24%, that would have been 96 to 182. If you had been in the 32%, that would have been 182, 100 to 231, 250. If you're in that range, then you would have been like, okay, well now I'm in the 32% bracket. And you can see that that's over, well, not over, but that's really close to about $100,000 of taxable income that you would have had to reduce for a single filer. And then if you would have been filing jointly, the amount to be in the 32% bracket would have been about $191,000 to $364,000. Again, a very difficult adjustment to make. That one is closer to about $200,000. It becomes very difficult for you to actually just automatically assume that my taxes are going to be lower because I'm living off of less of my income. Now, when you also take into consideration that we are at historical lows, if you had to guess where taxes are going to go when you're at historical lows, if they're going to go up or down, I mean, granted, I can't tell you which direction it's going to go, but it becomes reasonable to say if we're already at historical lows, then there's not much else to go except up. And we're not even talking about the deficit or even the consumer sentiment and just the way people feel about taxes and things of that nature. But you can see that it becomes very difficult to automatically assume that you're going to have lower taxes in the future. You may have the exact same taxes, you may have slightly higher taxes because they went up, but to automatically say my taxes will be lower is something that you would have to take into strong consideration. Number 3 is forgetting about Social Security taxes. Now, you may not know, but Social Security is taxed, and it's not a lot of income that it takes for it to be taxed. In fact, when you look at the numbers, it says if you make less than $25,000 as a single filer or $32,000 as a joint filer, then your Social Security payments won't be taxed at all. And you and I would say, okay, well, if I'm only making $25,000 a year or $32,000 a year jointly, well, that's not a lot of money for my retirement, especially if you take any income from any of your other investments, then you may automatically push yourself above that amount. And so you may be asking, Dre, how much would I be taxed if I was above that amount? And I'm glad you asked me. That's an excellent question. If you're filing as a single filer, so you're filing just your own taxes, you're not married or anything like that, and you make more than $25,000 and less than $34,000, then you can expect to be taxed on about 50% of your Social Security, right? Half of your Social Security. Now, for comparative purposes, the poverty line in the United States sits at about $15,000 in 2023. So if you were making more than $25,000 in your income during retirement, half of your Social Security is going to be taxed. And if you're a single filer who makes more than $34,000 a year, then you can expect to be taxed up to 85% of your Social Security. Again, that's not a lot of money for you to actually be making for you to be taxed. Now, when you're filing jointly, the number's a little bit higher, but it's still difficult if you think about two people living off of this income. So if you want half of your Social Security to be taxed, then you would need to make more than $32,000 in a year. And then you would increase to 85% of your Social Security being taxed if you were to make above $44,000 a year. More times than not, people don't really think about their Social Security being taxed, but when you see how low the amounts are, it's more likely than not that most of your Social Security is not only going to be taxed, but half up to 85% of it is going to be taxed, and you would need to be thinking about that when you're making your plan on your retirement. Number 4 we have on our list is ignoring the tax-free retirement income. So the number 1 and the most common one is going to be your Roth IRA. That is an after-tax asset. And all that means is Uncle Sam has already taxed the money that you put inside of your IRA versus your 401k where he hasn't taxed it. So the first time it's going to be taxed is in retirement. I find that it makes sense to have some amount of your retirement in tax-free income. Now, whether you have it in the Roth IRA and then you have the amounts that are contribution limits and you have the amounts of the income limits that make it a little bit difficult for everyone to qualify for it. It's also not something that you would just make as far as your only retirement option. And I'll put a link in the video to the 8 best retirement plans so you can take a look at that. But you want to have some amount of tax-free income. So currently, I believe the limit is set at about $6,500. That's what you can put inside of your Roth each year. Now, granted, if you're above 50, you have that extra $1,000 catch-up provision where you can put $7,500 inside of your Roth each year, and then that would be tax-free income. The beauty of tax-free income inside of your Roth is there's no required minimum distributions, which is a fancy way of saying you won't be penalized if you don't take the money out at 73 years old. You can leave the money in there as long as you want. And then when it's the only income that you have left, because normally, and we'll talk about in the next mistake that most people make when it comes to the tax planning for their retirement is they don't take the money out in the right order. So if you take your tax-free money out last, then that money is continuing to grow. The growth isn't going to be taxed, and then the distribution isn't going to be taxed. That's all your money because you paid the taxes on it when you put it in, and then Uncle Sam is going to leave you alone as long as you don't access that money before 59 and a half years old. Then you don't have to worry about any penalty when it comes to your Roth IRA. And if you are not able to qualify for a Roth, there are municipal bonds that you can look at, which is just government debt on a state level, and that's usually tax-free. Some people that have a certain amount of assets and a certain amount of income where it makes sense for them, they will put their money inside of cash value life insurance. Again, then they can access some of that money from the death benefit tax-free as well. Of course, that's a very unique circumstance, so it doesn't make sense for most people, but it does make sense for some people. The fifth one on our list is withdrawing your money in the wrong order. As I had teased for you in the last one, most people, and there is some debate, like most things, there's just some debate where you're just like, okay, sure, you think there's a better way, why not? I'm not going to argue with you over it. But most people would say you take the money that is tax normal, like your tax normal income first. And so that's like your regular income, your real estate income, just whatever type of income that you would take. That's any investments that is less than a year will be taxed as normal income. There's not really any tax benefits to that. So they say just take that first, just get that out of the way. And some of the advantages of that is when we move second into your tax deferred income, we talked about some of the risk of possibly having a higher tax bracket in retirement, or at least a higher tax rate system. And so if you do that one second, what may happen is you've gotten rid of all of your normal income, your regular taxable income, and as a result, you've lowered the overall income you have each year. And so maybe your tax deferred income, now that it's going to be taxed based on your current assets, maybe it will be lower because you've gotten rid of your taxable income first. Now, for some of you, you just can't get rid of it, right? You did such a great job. But either way, most of the time we'll say, hey, start with your normal tax income, then move to your tax deferred income, and then the last thing you'll take advantage of is your tax-free income. And the reason we do our tax-free income last is it doesn't have required minimum distributions, and there's no tax, fears as far as what may or may not happen with the tax code. Now, granted, they could make changes to the overall Roth and its structure, but normally once the money's in there, most of the time they make changes. It doesn't affect the people who are already in the system, right? Even when you change the Social Security and you raise the retirement age, it was always on a sliding scale where if you were a certain age, then you didn't have your retirement age change as far as what's considered full retirement. And then in the future generations, they made the change where, okay, now full retirement is much higher than it used to be. And so for the most part, it's not to say our government won't make some huge mistake, but just to say generally when it comes to the government adjustments of things, they don't do it to people who are already in that aspect of retirement. So that's normally the order that you'll go in. And then when you do your tax-free income last, you've allowed the tax-free income to grow into its highest amounts. And then you give yourself that advantage of going in a certain order where your taxable income, that tax deferred income, because you're not adding your normal tax income or your tax-free income to it, you give yourself the best chance to be able to maintain that tax bracket a little bit lower. But again, it depends a lot on each of our own situations. And the sixth and final tax planning mistake that most people make that could ruin their retirement is not having an understanding about the required minimum distributions. Now, we've talked a little bit about these. This is basically going to be your tax deferred assets. So your defined contribution plan, your 401k, your 403b, things of that nature. What Uncle Sam is saying is, I have allowed you to keep this money in a certain account without being taxed, and I'm only willing to wait so long. And because I'm only willing to wait so long, if you don't take the money out at 72, then I'm going to fine you a penalty. And that penalty is going to be half of whatever you should have withdrawn from that particular account. That is your required minimum distribution penalty. So if you calculate your retirement minimum distribution, so let's say you were required to take $30,000 out as your required minimum distribution. If you did not take out any of your retirement money, you left it in that pre-tax account, you would have a penalty that is equal to 50% of the amount that you should have taken out. So if you should have taken out the $30,000, your taxable penalty would be $15,000, which is a pretty steep penalty. And so whatever you were supposed to take out, whatever the amount you are short of that, half of that amount is going to be your penalty. And a lot of people overlook which accounts have a required minimum distribution. Naturally, if you have a fiduciary financial planner, they would be calculating this amount for you, and they'll let you know, hey, this is the amount that you need to take out this year for you to not have a penalty. It's also important to know that you basically have that first one. So before your 73rd birthday, you have until that April of the next year to take it out. So if you weren't considering your required minimum distribution, so let's say you turn 72 and you had till the next April. If you took your first distribution out in the April of the next year, well, you still have to take out your second year's distribution before December 31st of that same year. So ideally, you'll take the first distribution out in the first year, right? There's no reason to wait for the next year. I mean, there may be a reason to wait. I don't really know, but ideally, you'll take the first required amount out in the first year, and then you'll take the second required amount out the next year. Now, because that first year you have the ability to wait until the April of the next year, you could find yourself having to take 2 required minimum distributions that same year, and then that may put you in a different tax bracket. So it's just something for you to consider and to think about. Now, also, I have some tax planning strategies for you for the overall retirement, just some general thoughts. And again, if you want access to this guidebook, you would just go to obsidianwisdom.com/tax planning. But we'll go over some of them. So if you're in a lower tax bracket, so if you're in the 0, 10, or 12% currently, if you're paying little to no taxes today, ideally and realistically, you'll pay little to no taxes in the future. But it still may make sense for you to minimize the taxes you're paying today by using a tax deferred account. So it may be in your best interest to put the money away tax deferred, because more times than not, when they increase taxes in the future, it's not going to be the lowest tax brackets. Those are normally the ones that stay the same. So if you defer your taxes for the future, then you'll probably pay a low tax bracket then. You'll probably pay a low tax bracket today. It's really up to you. You have a lot of flexibility as far as the way things have historically been done. If you're in the moderate tax bracket, so that's normally the 22 to 24%. If you feel like you pay a moderate amount of taxes, then you'll probably pay a moderate amount of taxes in the future. And as a result, I would normally tell you to kind of split the baby on that one. And what I mean is you would have about half of your investments in pre-tax assets like your 401k and your 403b, and then you would have half of your retirement income assets and after tax. That could be in the stock market or a business and real estate, things like that, where you have half of your income coming from money that's already been taxed, your Roth and the business and other things, and then you have half of your money coming from assets that haven't been taxed. That's the 401k and the 403b. As a result, you have a little bit more flexibility. So if for some reason we go into an economic climate where taxes are going to be raised significantly in the future, well, then you would say, okay, I'm going to shift more of my money going forward to being taxed now, so after-tax assets, so that way when I retire, I've already paid the taxes and I've minimized the taxes that I'll have to pay in retirement. If you find out that someone has promised to make taxes 0% for everyone in the future, well, then you may say, okay, based on that, I'm going to shift more of my future contributions to my pre-tax assets. I don't want to pay taxes today at 22%. I want them to be 0% in the future. Now, granted, we don't know if either of those are going to happen, but you would have that flexibility because you're already about 50-50 on each of them. And then the last one, if you are in the higher tax bracket, so if you're in the 32, 35, or 37%, the reality is you're probably going to pay higher taxes in retirement and you're going to pay higher taxes today. Now, I would still maximize all of my retirement accounts, but because you're in the higher income bracket, you can only put so much. So you can put like $20,000 in a 401k. You can put like $6,500 inside of a Roth. So you've already maxed these out and you still have a whole bunch of income left. So once you maximize all of the accounts and take advantage of all the opportunities, you'll still have enough income left that you're probably going to still be in that high 32% tax bracket, right? That's just not much you can do about it. I still would take advantage of all the accounts. I would still maximize all the accounts to give myself the best possible situation, but just understand that most likely you're not going to be able to lower what your taxes are in your planning, but you still will put your money away. Now, if you made a complete shift and you put most and all of your money inside of tax-free assets, so maybe you do a Roth conversion where you would do an IRA rollover. That's called a backdoor Roth, and which is just a very fancy way of saying you're not able to get a Roth just in a normal situation because you make above the income limits. But if you put the money inside of an IRA and then converted the IRA into a Roth, as a result, you would pay the taxes today on that for converting it over, but then that money is tax-free income that you have and you set there. You can, I remember when Mitt Romney, when he was running for president, I think it was in like 2010 or somewhere around there, and they were saying, how does he have $1 million inside of Roths for his kids? And then everybody was kind of, pretending like they had no idea why. They're like, oh, this is wrong, and somebody should, be arrested or investigated or something like that. It's not illegal. It's totally allowed. It's called a backdoor Roth, and you're able to do it. All of us are able to do it if we so wanted to. It's just whether we need to or whether it makes sense for us financially. But all of us have the ability. Now, sometimes our Congress does have debates, and there was a tax law, I think the Build Back Better plan, when Biden had presented it, it had a portion of it where it took away the backdoor Roth. It didn't end up passing, or at least that portion was taken out, and maybe the version that did pass. But there is the possibility that it won't be an option at some point in time. But it currently is, it has been, it's totally legal, and it's acceptable, and you can take advantage of that. In fact, I talk to people about putting Roth conversions inside of their retirement plan so they can maximize the tax planning. And so what happens is, and I may be able to put a chart inside of it, but what ends up happening is you have your normal income, right? So you have your normal income and you're making all your income. And then somewhere in between your Social Security, assuming that you're going to not take Social Security right when you retire, there is this dip to where you go from your salary income and then you start using some of your investments. So there's this dip, and then you get Social Security and then your other investments. So it kind of goes back up. So you have this little trough, we'll say, of income. Now, what some people will do is they will put what is a Roth conversion. So what you'll say is, okay, when I have the lowest income, in between my active income that I've earned and before all of my retirement kicks in with my RMDs and Social Security, I will convert one of my IRAs into a Roth. So I will take one of my IRAs that is in a pre-tax account, and then I will convert that into a Roth IRA, and I'll pay taxes on that conversion. As a result, now, instead of me having all of this money set aside in my IRA, which is not taxed yet, and then maybe when my Social Security and all my other accounts become active, I have this higher income, so then my deferred assets are now going to be taxed at a higher amount. Instead, if I convert some of them in that trough where I have my lowest income, then maybe I'm able to pay a lower tax bracket because I have a lower income there. And so that's just called a Roth conversion. I'm not going to go into a lot of detail about that, but it does make sense for some people. Now, granted, if you want to look at that, I do encourage you to download the Retirement Planning Guidebook, and you can go to obsidianwisdom.com/tax planning. If you have any questions about your retirement planning, then you'll want to like and subscribe to this video, turn on notifications. I put out lots of videos to help you plan for retiring, whether you're 30 or 130, where you are able to maximize your income so you can maximize your money and minimize your fears so that you can live your best life.